Is the multi-billion-dollar AI boom about to come crashing down? For over a year, tech giants have spent historic amounts of cash building massive data centers. But a series of shocking new financial red flags suggests an historic oversupply crisis is already here. The AI gold rush is hitting a massive wall, and the hardware giants driving this boom are suddenly on thin ice. Last week, the AI narrative suffered back-to-back cracks. First, Meta began renting out its surplus computing power. Then, Oracle dropped a bomb in its latest financial report, warning that the aggressive global expansion of data centers might never break even. If major clients fail to pay or renew their contracts, tech giants will be left holding a mountain of idle, incredibly expensive assets. But the loudest alarm bell came from Blackstone. This private equity titan has been enthusiastically acting as the ultimate AI landlord. Yet, they just abruptly dumped $3.5 billion worth of equity in 3 major U.S. data centers, pulling back from the world's largest data center development project. One red flag could be a fluke. Several at once? That means it's time to wake up. Astronomical sums of cash have been poured into this AI arms race. But investors are no longer buying the hype. They want to see the money. And right now, pure hype is no longer enough to keep tech and chip stocks pumping. Look at how Blackstone executed its exit. Their real estate trust sold its stake in 3 massive Northern Virginia data centers to Digital Realty, the absolute king of the global data center leasing market, the company that builds infrastructure for Amazon, Microsoft, and Google. The enterprise value of these assets is a staggering $7.8 billion. Blackstone sold a 64% stake, walking away with $1.2 billion in cash and $2.3 billion in Digital Realty stock. Because these data centers are fully leased and generating peak revenue, Wall Street analysts called this a masterclass in cashing out at the absolute top. Swapping assets and dodging risk. Think about it. Blackstone deployed capital back in 2021, long before the masses realized what was happening. Nvidia didn't even take off until 2023. A private equity giant that is always 3 steps ahead doesn't just sell for no reason. By converting physical bricks-and-mortar data centers into highly liquid stock, they can now quietly exit the market whenever they want. Meanwhile, Oracle is on the exact opposite side of this trade. Over the past month, Oracle's stock has plummeted 42%, wiping out over $265 billion in market value. Their free cash flow has plunged to negative $23.7 billion, while their debt has ballooned to $130 billion. And the nightmare is just getting started. Oracle's negative free cash flow is projected to widen quarter after quarter, potentially bleeding a horrifying $100 billion over the next year. With cash evaporating and interest payments spiking, Oracle is facing a brutal choice: start panic-selling data centers or drastically halt their investments. The paradox is that Oracle's actual demand looks great on paper. Their contracted revenue backlog hit a stunning $638 billion last quarter, fueled by massive deals with OpenAI and SoftBank. Their cloud infrastructure revenue even surged 93%. But feeding this monster is becoming unsustainable. To fulfill these orders, Oracle's capital expenditure for fiscal year 2026 has been pushed to nearly $56 billion. They've already raised $48 billion in debt and equity this year, and they need another $40 billion next year, bringing their total spending plan to an eye-watering $90 to $95 billion. To desperately save cash, they've already axed 30,000 employees, 18% of their workforce. Make no mistake, this isn't the AI bubble bursting just yet. It's the market finally demanding proof of profitability. If GPU demand and data center spending slow down simultaneously over the next few quarters, the AI arms dealers are in serious trouble. The tech rally is no longer fueled by promises. The upcoming earnings reports from the world's largest cloud providers will determine whether the AI revolution keeps marching forward or suffers a historic crash. So, keep your eyes peeled. The upcoming earnings reports, forward guidance, and financial health of the next round of mega cloud providers are now the absolute make-or-break signals. Their results will be the ultimate reality check and the fundamental condition for whether tech stocks can actually sustain their upward rally. Watch these signs closely. They will tell us exactly where the market is headed next.